Hello, I'm John Cogan, the CEO of Proformative, the leading platform for professional development across the Office of the CFO. I'd like to welcome everyone to today's event entitled Scaling Your Talent Strategy, Creating Efficient Systems for Hiring, Paying, and Retaining a Global Workforce. I'd like to thank our sponsor, Radius, whose commitment to thought leadership in this realm helps us make today's educational webinar possible and delivered at no cost to the participants. As your organization expands internationally, the complexity of your operations will increase. The manner in which your company hires, pays, and retains your employees is critical to delivering sustainable growth in international markets. Today, we will discover best practices and common pitfalls when planning for and executing your international staffing strategies for 2016 and beyond. We have a few learning objectives for today's event. Number one, prepare an accurate budget for international expansion. Number two, understand how your staffing costs will vary country to country. And number three, compare regional tax issues and regulatory compliance requirements. So we've got a lot of ground to cover, and we've got a wonderful speaker who I'll introduce in a few moments who will help us get there. Before that, we've got a few housekeeping notes, so let's run through all of that stuff. If you are interested in the slides, and we've got great slides today, they are available under the handouts section of your GoToWebinar control panel. So to find that, go to the GoToWebinar control panel. You might have to hit the blue flower-like icon in your applications area to pull that up to the top, and then towards the bottom you will see the word handouts. There might be a plus next to that word. You'll have to hit that in order to expand the handout zone and get to the download. But there's a PDF there of the slides, and you can grab those at any time. Also, we will send you an email within the next 24 hours. That email will have a link to download those self-same slides and also access a recording of this webinar, which we are making right now. We are offering CPE for today's event. If you're interested in CPE, please remain for the duration of the hour and answer all three polling questions. If you have any questions on CPE, just email us, cpe@proformative.com. We would like this to be an interactive event. Your GoToWebinar control panel has a section on it called Questions. We encourage you to use that. Your questions will be anonymized. No one else on the call will see who's asking, and we won't announce your name, so don't worry about that. But we strongly encourage and love getting questions, and we've got a great subject matter expert on hand today to answer all of your questions. So feel free to ask at any time, and when we get to the Q&A portion of the event, we will do our best to get to all questions. Then finally, the last thing we'll have you doing today is taking a short survey at the end of the webinar. This is how we get feedback, helps us understand how we're doing, how the speaker's doing. Do you have any suggestions? We love all of that input. So thank you in advance for giving us that last minute of your time and attention. Also, if you're interested in connecting with the speaker or our sponsor, Radius, you can do so with a click of a mouse in that post-event survey. So that's a super easy way to request some follow-up if you'd like that. Next, quick welcome to Proformative for returnees and first-timers alike. Proformative is the leading professional development resource for every member of the Office of the CFO. We do over 200 webinars just like this one, so virtually every business day of the year we're online with folks. So thanks so much for joining us for today's. We also have a massive online community, over 2 million unique visitors a year, over 10,000 discussions ongoing. So it's a great place to meet your peers. And then also we recently launched Proformative Academy, which is on-demand video courses, almost 300 of them at this point, and growing very rapidly, and CPE galore. And all of that for simply $99 per year, unlimited access, so unlimited CPE and learning on demand. So that's Proformative. Thanks for joining us today. Now let's go ahead and get into the reason we're all here, to learn about scaling your talent strategy globally. And joining us today on this learning adventure is Katie Davies, Senior Director at Radius. Katie oversees Radius's advisory client engagements across 5 continents. She is expert in a wide variety of cross-border issues, including human resources, tax, intellectual property, and immigration consulting. Katie also provides hands-on client services to many of the firm's U.S.-based accounts with operations in Europe. Katie, thanks so much for joining us today. It's a great pleasure to have you back on board, and just wonderful to be starting off our week with you.
Thanks very much, John, and good morning, good afternoon, everyone on the call. So today's session, we are going to look at some of the considerations about hiring and maintaining a globally efficient workforce, and this is the agenda that we're going to try and sort of gallop through. There's an awful lot to address, and this is going to be very much an oversight as to the interconnection between these different areas as you think about growing and expanding your international footprint. So we'll start with the next slide. Why does a company structure matter? And predominantly this is an HR discussion, but I always start with what do you need in order to be able to employ somebody, and that comes down to company structure. So company structural considerations are the #1 priority when you are thinking about hiring for the first time or extending or expanding your international footprint. And part of the reason is, you know, if you have an entity in a local country, then that's obviously going to be easier to attract talent. It's going to be hard to get people to move from one company to another if you don't actually have anything in territory, because what commitment does that show to your prospective employees about your commitment to a particular new market? But more importantly, in order to hire people in an international country, you will typically need some form of employer registration, and that may or may not require you to set up a formal legal presence. At a very minimum, it's typical that you're going to have to set up a payroll-only registration. And it's critical to understand what types of registrations are going to be required in order to support those employees, because that in turn will have a timeline and a deadline for making submissions and actually finalizing the registrations. And in many countries, you're not legally able to hire people without those registrations being in place. So if you've got your HR function or your sales operation wanting to make a hire on the 1st of December, but it takes 3 months to set up the entity, you've got a problem. So it's important to recognize that timing right up front. And further, when you come to structure someone's package in terms of employee benefits, the availability of certain employee benefits may be limited by the form and type of registration or company that you've actually incorporated. So company structure does matter. Next. To determine whether or not you can get away with a simple registration such as a payroll only, we have to dive into corporate tax questions. And the basic one is whether or not you have what we call a permanent establishment or a corporate tax nexus. And that basically is an establishment whereby the local authorities or the local tax office will deem that the activities being provided in country generate corporate taxable profits. Typically, signals of that are activities performed through a fixed place of business, such as an office, or whether or not sales contracts or other binding forms of revenue are being signed in country. If you're deemed to have a permanent establishment, it is typical that you're going to have to register something more than just a payroll-only registration. And a branch and a subsidiary are typical forms of permanent establishment in a particular country. A representative office or a payroll-only registration typically will not trigger a corporate tax profile. So understanding what triggers the corporate tax profile is absolutely fundamental to being able to determine what type of entity needs to be established or not. And as I said on the previous slide, that in turn will dictate the hiring timeline that you need to be cognizant of. Next. So as we begin to think about hiring up and starting that international entity, there are basically 3 choices that you have. You can hire local employees, typically local nationals, but they may not be. You might want to send across expatriate employees from the home country head office, or you might decide to hire independent contractors. Now, we will go into the advantages of the contractor arrangement, but remember that a local employee or an expatriate employee will typically require some form of payroll withholding in country. And further, if you have expatriate employees or non-local national employees, you're going to have to think about immigration and work permits as an absolute priority before you make offers of employment. The other alternative that you might have is, can you use some sort of third party as an interim employer? We call them PEOs, or professional employer organizations, and they are, a valid option to hire people internationally. However, they have to be used with caution. They're not always legal in every single country, and typically they are seen as a short-term stopgap whilst an organization gets itself sorted as to what sort of organization and structure may be required in a territory. So PEOs may be a quick win to kind of get somebody employed, but they certainly shouldn't be regarded as a long-term option. I believe we have a polling question next, John.
We absolutely do. This is the first of our 3 polling questions that I'm launching right now. And as I will do for all 3 polling questions, I will leave it out for 30 seconds. And we'd love to hear from everyone, whether you're here for CPE or not. Your answers are anonymized, so no one will see what your vote is, but it is very interesting, A, to see what's going on with the general populace here. We've got a good population on today's webinar. And B, it helps our speaker, Katie, understand who's in the audience and where they're coming from, what their perspectives and priorities are, etc. So very handy to get great input across the board today. So don't be shy. And what we're going to do, now that we've kept that open longer than 30 seconds, is we'll close it down and we'll share out the results so we can all see what's going on here. So the question was, which of the following do you view as the top opportunity for global expansion for your company, presumably? And Katie, what do you think about this spread of answers here?
It's interesting because Europe usually triggers around 50% interest, and here you can see it's skewed to other territories, quite frankly, other than Europe. So China, obviously, as a single country, major opportunity, about a third of the responses. Doesn't surprise me in terms of the opportunity, but the challenges of actually understanding that culture and that business environment is difficult. So definitely would seek advice before going to somewhere like China, and obviously Latin America as well is very interesting. We definitely are seeing an uptick in interest in Latin America, particularly Brazil.
Interesting. Great, thank you.
Okay, so moving on, we are now just looking at the requirements around hiring local hires. So we'll look at each of those buckets of employees in turn, the first one being local hires. So oftentimes I'm on the phone with HR departments or finance teams, and there's a basic misunderstanding that you can get away with doing what you do in the US in the overseas territory. And the simple answer is, US employment law benefit environment is very different to the environment that you will experience in many other countries. So each country will have its own unique rules and regulations. And if you don't have a basic concept or understanding of those rules and regulations, you'll very quickly disengage your employees, and they will, use the expression, well, I work for an American company, they just don't get it. So the key to what we try and advise is giving you the information, or at least the bandwidth, to be able to answer questions, to make sure that you're prepared for what you're about to approach in a particular country. Because nothing worse than being caught out by what a local employee would regard as a very basic question. So I think the key one here is being open and ready to embrace the fact that everything is going to be different and wanting to learn about those nuances. And the problem is that oftentimes international employees, particularly in startup type environments, is a very small percentage of your workforce. So you end up spending a disproportionate amount of time supporting a smaller fraction of your employee workforce compared to your domestic workforce. But I think if you go in with an open mind, then at least you know what you're going to be faced with. The next. So on the screen is literally a very simple, basic US offer letter. It talks about the remuneration, the amount of money you're going to get a month. It talks about US-style benefit programs, stock options or equity reward, and importantly, that last bullet, that the employment is at will. And if you look at each of those elements, these are all going to be different overseas, and actually the level and detail of what you would have in a US offer letter is much, much reduced and simplified compared to what you have in an overseas employment contract. Next. So let's pick up on a couple of these points. So US employment at will, basically the ability to get rid of employees, both the employee and the employer, at will. That is a concept which just does not exist outside of the US. In other jurisdictions, other countries, there will always be some form of termination provision. There might be a trial or a temporary employment period, a probation period, during which it may be easier to terminate or move on from that employee. But on the whole, there are going to be notice periods that you have to abide by, as well as a due process to actually affect the termination. And it's really important to understand that basic concept, because failure to do so could result in very significant penalties for removing employees. And I always seem to start with the negative of terminating employees, even though we're starting about the positive of hiring, but it's the biggest one that catches out US employers. The second is to have a locally compliant employment contract, which actually applies to the jurisdiction in which the employees are working. So the basic rule is, even if you don't have a written employment contract, whether that's legal or illegal, the employee will automatically default to having the protections of the employment jurisdiction in the territory in which they are working. So even if you had a US-style employment contract or an offer letter, you are still going to be on the hook for all the obligations and mandatory employment laws that exist in a particular territory, because there is an automatic entitlement if you're working there. And of course, the employment contract not only covers the local statutory requirement, but it also includes areas such as post-termination restrictions, Inventions Act, and other sort of restrictions that you might want to build into your employment, such as confidentiality. And it's important to understand the interplay of domestic legislation. So, for example, in Germany, if you put a non-compete clause in the employment contract, then in order for that to be enforceable, you need to state how much money you're prepared to pay to that individual during the non-compete clause in order to make it enforceable. And even if you include it as a deterrent, as part of the employment contract, and then subsequently want to waiver that obligation on the employee because you decide that you're letting them go off free, the employee could actually impose the fact that they want to be paid during the non-compete period for whatever reason. Perhaps they've decided to just stay at home for 6 months. So understanding the ramifications down the line of what you're putting in as a point of detail really catches people out. So it's important to take that good advice right up front. Next. So in some countries, there is no legal obligation to have to provide an employment contract, but we would always recommend that it's best practice to have written terms and conditions written down for clarity so that everybody knows what they're shooting towards and managing against. And particularly when it comes to things like, what are the mandated requirements for things like employee benefits. The key here is understanding the territory in which you're working, which is an obvious point. But in some countries like Spain, Italy, France, even countries like Germany potentially, depending on the number of employees that you have, you can be caught by other legislation which impacts on domestic employment law, such as collective bargaining agreements or trade unions or collective agreements. And these are important because they waiver on an industry by industry or job grade specific basis the terms that you have to provide to somebody. For example, working time, overtime provisions, and other sort of key benefits that might need to be provided to somebody. So understanding the territory and the interplay with these collective union agreements, even if you've only got 1 or 2 employees, is absolutely vital. And that's what catches a lot of US companies out, is because they really don't understand the interplay with these collective agreements. Next. Another important point is in many countries, the employment contract, in order to be legally binding, has to be written in the local language. And that not only extends to the basic employment contract, but also to any supplemental documents such as proprietary agreements, confidentiality agreements, equity awards, stock option agreements, etc. All need to be legally translated. And if they're not, then if you end up in court in that particular territory, then the courts will insist the documents are translated, and it is the local translation or interpretation of the English that will take precedence. So it is advisable to make sure that you have everything translated and in place right from the get-go. Now, of course, that can get very expensive. So as we begin to think about planning for the cost of expansion internationally, or whether you're thinking about taking on a new country, these are the elements that we need to start building in. And you certainly don't want to be doing it at the last minute as you're preparing for a court case. One of the warnings that I have up here is being careful about cavalier promises that you build into the employment contract. For example, you might promise someone entitlement to medical insurance or other forms of insurances, and the insurance company may, for whatever reason, limit or prohibit an individual from obtaining that insurance, perhaps because of a pre-existing medical condition. So you need to be extremely careful about how you phrase their entitlement to certain insurances to make sure that the company is actually not on the hook for actually providing that insurance where the insurance company is not otherwise prepared to provide it. So you might write something into the employment contract such as an entitlement to participate in an insurance plan subject to the agreement or approval of the insurance company, as opposed to an absolute assurance that they will obtain that medical insurance. The key here is clearly to understand the specific requirements of the particular location. Next. Just to highlight some of these points, I'm just going to take an example of France. And I'm sure if any of you have worked with France, you'll understand why. The HR environment in France is particularly difficult. You have the interplay of domestic federal legislation overlaid with very sophisticated and detailed collective bargaining agreements that apply to any particular industry sector. And then within that, you have different requirements based on grade and seniority. So when you hire somebody in France, you have an obligation to fill out what's called a DPAE, and it's a Social Security Authority declaration. And you're meant to do that before the date of hire. So oftentimes I'll get a call from the finance or the HR team saying, we hired somebody last week in France, but we need to pay him next week. And the honest answer is they've already blotted their copybook by employing them and not filling out the necessary hiring declarations in advance of hire. The second piece is to do with a medical examination, which is meant to happen within the first 3 months of hire and then every 2 years subsequently. As part of preparing the employment contract, it will be necessary to determine the level or grade of the employee. We call that the job coefficient, because that will affect entitlement to certain benefits such as minimum wage and working time. And then in France, there are other mandatory obligations which are predetermined by the relevant collective bargaining agreement. They're called the prévoyance insurances. It covers things like death and disability insurance, and they are meant to be in place from day one of employment. Now, if you are a new employer in France, it takes a number of weeks or months to get the payroll registered. After you've got the payroll registered, you then have to set up these insurances. It all takes time. So if you go back to those first initial slides that I had about company structure and the registration, if you think about the fact that these mandatory insurances need to be in place from day one of employment, it means you have a lead time of at least 2 to 3 months, probably closer to 3 to 4 months in France, before you can technically employ somebody legally. So again, that planning phase and making sure your timelines are correct is really vital. And you'll see in the last bullet point there, I referenced that by reference to the fact that you need to have your Social Security registration in place. It's called the SIRET number, before you can start employing people in France. And that's the delicacy in France, is the timeline of getting everything in place with the Social Security Administration. If we go on to the next slide, sticking with the topic of France, the ongoing HR requirements includes things like mandatory training and monitoring credits for time off that you have to give to your staff for training, the ongoing tracking of vacation and days out of the office, whether that's for sick leave or vacation or for training, and these all need to be recorded as individual line items on the payslip. And if you fail to do that, then you can have a significant accrued vacation balance payable upon termination because there's no official record of these days having been taken. There are health and safety obligations, and if the employee works from home, then it's at every single office that your employees are working from. So if you have 5 employees in France, all working from their home offices in different provinces or states within France, you could have actually 5 separate health and safety requirements. And that may include the inspector coming out physically to the employee's home office. If you do have a physical office space in France, then there are things called office postings where you basically post up health and safety requirements, details of things like the labor inspection, contact details, emergency services, the laws and harassment, discrimination, etc. So there's some basic bureaucracy and administration that has to happen to underpin the compliant hiring in France. And then we get on to very specific working time legislation. In France, the maximum working time, technically, the basic rule is 35 hours a week. And under the CBA, that can be flexed by up to 10%. So you get up to about 38.5 hours. And anything over and above that either has to be paid by way of overtime up to certain limits, or there is a concept of what we call RTT days, where you basically give extra days vacation, called RTT days, in lieu of having to track the overtime. However, you still actually have to record the number of hours. So that has an implication for your systems because you are now having to track timesheet management, which may not be prevalent in the rest of your business. But it's understanding these nuances and how it can come back and bite you, and planning for your population, which is really important. And then the final point on France is termination. And again, I'm sure many of you on the phone will have had experiences of having to pay huge settlements. Up to anything from 9 to 18 months worth of salary can be included as a termination payment in France. It's heavily regulated. The employees in France will invariably know their rights and their obligations, and some employees make an absolute career of bouncing from job to job, going through an unsatisfactory separation and getting huge payouts. It's sort of a way of life is a bad way to put it, but there is certainly a school of thought which says there are a population of employees in France that do live by that mantra, which is not helpful when you're trying to have a startup business. The key message about France is that if you want to terminate somebody, you do it through the first trial period or probation period in the first 3 to 4 months of employment, and you make sure you are monitoring and reviewing performance much more closely than you might with any other employee domestically in the US. So again, the point here is about good, strong HR management and really understanding the ramifications if you don't. So you've got to be really on your game. In France, it's incredibly difficult to make people redundant for economic reasons. So invariably, you end up having to part company on a mutually agreeable basis, and that's where the settlements of, as I said, 9 to 18 months is typically come in by way of severance payments. So we're going to leave France now. The purpose of going through that example was really just to illustrate the nuances and the points of detail that I've been describing in more generic terms. We move on to employee benefit considerations, and the key here is that you start thinking about the taxes, the social taxes that you are paying through your obligatory payroll costs. And in that, you will have as an employer certain costs. So for example, in France, the employer social security rate is about 45%. Countries like Belgium, it's about 32. The UK, it's 13.8. And each country will have its own rate. So it's essential that you understand what those costs are from your budgeting perspective. But that's also important because it will actually also give you a good indication of what supplemental insurances or best practice insurances might be payable on top. Typically where you have a very rich social security system indicated by a rich or costly contribution threshold, you wouldn't typically expect significant supplemental benefits because they're all provided by the state. So it's really important to kind of get a clarity on that, because if you try and put in place a US-style benefit program across countries with high social security, you'll effectively be double counting. And that's an important area in terms of cost management. The other area to think about is the fact that mandatory obligations are not just for Social Security. There might be elements that are provided for under the collective bargaining agreement. Again, going back to France, the different collective bargaining agreements will state which insurance company has to provide those prévoyance, or the death and disability insurances. Next. The key here is really to be sensitive and understand the landscape in each country with respect to the social and statutory obligations that you are obliged to pay. Language and culture, so what's common? In Netherlands, Germany, it's very common if you're in a sales environment to be physically provided with a company car, for example. However, if you're a newly set up business, it's incredibly hard to actually take out a car lease because you don't have any credit in country. So notwithstanding the fact it may be best practice or expected, you physically may just not have the ability to take out a company car lease. There are alternatives. You might provide cash, may or may not be as tax advantageous to the employee, or you might insist that the employee takes out a lease or a rental agreement in their own name, and of course that can be costly. So there are workarounds, but understanding the environment gives you the ability to talk to the employees in an informed way during that hiring process, and making sure, as I mentioned at the outset, that you're not caught out. The other thing that we discover a lot is that US companies will typically provide a good part of compensation through equity. Now, in different countries, the balance of cash versus benefits versus equity can be very similar to the US, and people regard equity with equal importance. But in other countries, people regard it as simply a top-up, a nice to have, and they don't regard it truly as a solid part of their base remuneration. So trying to balance that, and if you're trying to reduce someone's salary in lieu of offering them stock options or equity, that can be a difficult sell in some countries. So the key here is really, we would always recommend some sort of employee benefit benchmarking in the particular sector for your size of employer, and in reference to the particular country in which you're working. Next. So the key to all of these elements is around good HR administration. By that I mean planning, cost analysis, and having this infrastructure in place to monitor, maintain, and control those HR systems going forward. You know, trying to put in place multiple plans in multiple countries can be time-consuming, and a one umbrella plan is likely not to be appropriate, particularly for smaller companies. But you do need to understand the time and the cost impact of having to set up multiple plans on a bespoke country-by-country basis. And it is really difficult to try and put in place an umbrella scheme with one provider. And in my years of doing this work, we struggle with that particular part more than anything from an HR perspective, because typically it's just not appropriate. And the cost of having an umbrella plan really, the employees don't really regard it, and it is difficult to actually set up effectively. Next. We're now going to move on to looking at that next bucket of personnel, which might be the choice between a contractor and employee. And the first question is, can you hire a contractor, or are they really a de facto employee? And the honest answer is that the tests that are internationally recognized are very similar to the tests that you have in the US. So, for example, are they free to work for other organizations? Are they bound to work for you solely, or can they actually go out and provide services to other people? Do they hold themselves out as your representatives? Do they hold your business card? Do they have the right to substitute their labor for somebody else's labor? Go on to the next slide. The use to use their own equipment, or do you provide it all to them? And do you give people equity or other employee incentive compensation, which would typically be reserved for employees? Now, the answers to those are pretty intuitive, I think. If you answer yes, they can use their own equipment, yes, we give them stock options and employee incentives, then the answer is going to be that probably they are seen to be or would be seen to be an employee should the position ever be reviewed. And those tests are very similar to the ones that you have in the US. Why does it? So we're going to look at that after the next polling question. And John, if you want to pull that up.
Let's do it. Polling question number 2 coming up right now. As before, we'll leave it up for 30 seconds, give you plenty of time to answer the question, what do you view as the top risk to your firm in expanding across borders? And we've got a few different selections there for you. I'll remind folks you can ask questions at any time while you're interacting with GoToWebinar here. In the control panel, I'll remind you there's a questions area there, and you can ask your questions at any time. They'll queue up for the Q&A portion of today's event. I will leave this polling question out for 5 more seconds just to make sure that everyone gets a chance to get their vote in. And at this point, I'll close that down as we did last time. Let's go ahead and share out the results and see what we've got. Okay, here we go. I'm not quite as even-handed as last time. Katie, what do you think about the answers we've got here?
Well, I guess given the audience of finance folks, compliance with international regulations doesn't surprise me. The one that does surprise me, and I think folks need to perhaps take a look at this, is the 5% for the data privacy. Because data privacy in terms of the international environment, particularly in light of recent events to do with the deterioration or the inability to rely on safe harbor provisions, particularly with exchanges of private data to Europe, should be top of everyone's agenda right now in terms of making sure that they understand the data privacy environment and understanding their compliance obligations. Unfortunately, it's one of the boring, driest subjects that one could ever not wish to have to deal with, but it is something when you're working in the international environment that has to be understood. Otherwise, you know, people will fall foul of it. And it only is one of those terrible issues that only really becomes an issue when it becomes an issue. So I would encourage folks to have a look at that. Alrighty, so let's get back to looking at our contractor arrangements. Now, the benefits, why would you want to go down the route of a contractor, even if you're sort of on the fence as to whether or not you truly have a genuine contractor versus an employee? Well, you know, a contractor, it's relatively straightforward. You know, when you're setting up for the first time, it's a light touch, it's a light footprint, it's very quick to put in place. It's typically the US standard contractor agreement, maybe with a few tweaks to the local jurisdiction. As long as you've got a candidate who's willing to provide contractor services on that basis, it's a kind of a quick win. It gets you going. And sometimes it's seen as a short-term temporary gap before you actually have your full-blown entity or payroll being set up. However, the problems with this are once it's in place, oftentimes, you know, when something's happening and it's working okay, there is a genuine reluctance, I think, in people's persona. You know, life gets old, you move on, and you don't go back and revisit it. So eventually, even though it was intended to be a short-term stopgap, it can become a longer-term arrangement inadvertently. So being really conscious of managing your timelines is key. The authorities, whether or not that's through from a tax audit or whether it's through an employment audit, will look at contractual agreements as one of their top focus. I'm sure that's the same in the US, where, you know, contractual agreements are a soft target. So they will go at them, they'll look at them, they'll look at the details, the substance over the form. It doesn't matter what's written, it will depend on what actually is happening. So truly, can you stand behind your contractual agreement? And if you know the answer is, well, probably not, then, you know, you have to accept there is a risk there. And the risk is, firstly, that your employee could take you to court for unfair dismissal or some sort of breach of employment law, which you may not have a good handle on, because if you're not familiar with the territory, as we've just been through, you may not be aware of all the things that you should be doing. And obviously from a tax perspective, Social Security, there is the failure to withhold taxes through payroll. There is the failure to pay employer taxes through Social Security. So typically, the tax authorities will go back potentially, right to the very beginning of the arrangement. It could be longer than 6 years, and insist that the companies pay back those taxes. And then the other point is more from an HR perspective, is that you're putting that burden on the employee. They may not be familiar with having to file their own taxes. It may be the first time if they've converted from an employee to a contractor status, and suddenly they're having to do more admin from an internal management perspective than they're prepared for. And that can be a distraction to them doing their day job, which is what you're really employing them to do. So there are some pros and there are some certain disadvantages of having that contractor arrangement. Next, I'm just going to run through a quick case study that we had. We had an independent contractor hired in Colombia. Latin America, South America, as we saw from the first slide, increasingly popular, but it's incredibly difficult to actually get a handle on how well is our business going to do. We want to be quick and nimble. We want to touch the ground quickly. Therefore, contractors are oftentimes used just to kind of get going in Latin America. And certainly that was the case in this example. The independent contractor was in place for 5 years. And we all know that really that looked and felt like an employee relationship because they were working solely for that individual company. And then after 5 years, everything was good except for the fact that the company, due to economic downturn, decided to retrench from the territory and needed to get rid of the contractor. So they effectively terminated her in accordance with her contractor agreement. And of course, she ran straight to the labor courts and proved successfully that she was in fact an employee. She'd worked for one company for 5 years, she'd held herself out, etc., etc. So the result was that the company had to go back and settle all back taxes. They had to effectively gross up the taxes that they failed to deduct from her. So effectively what she received in her hand was deemed to be net income. They had Social Security and other social taxes to pay back, as well as all the accrued vacation and 13-month payments that accrued in that particular country. So in some countries, you don't just get paid in 12 monthly installments, you have what's called holiday payments, and those, if they're not stated or paid, are payable on top of the annual salary. So again, understanding that liability and exposure was important. And that was a significant settlement that company had to pay out, nearly $500,000 worth. So it was, for one person, was a significant pain point. And of course, once you've got it wrong, you're going to be on the hook, and your profile is going to be up there with the tax authorities. So coming on to the last bucket of population that you might think about, expats. This is typically where you have got head office people or employees in the home territory that you think are going to be helpful to you to deploy into the host country or the new territory to hit the ground running. They understand your business. They're going to be able to set you up commercially much faster than if you try to train up people that basically don't understand your business. However, whilst that's all great in theory, when you send an expat, let's say from the US overseas, it creates a whole host of different issues that you may not have thought about if you haven't dealt with expats before. And it's vital that if you are considering having an expat assignment for however long, whether it's 3, 6, 12, 24 months or longer, that you take full advice up front in advance as you begin to think about it so that you understand the ramifications. And part of that stems from immigration, the need to have a work permit or a visa, which depending on your company structure, slide 1, you may or may not be able to have, because if you don't have a legal entity in territory, it may be difficult to actually sponsor the work permit. Through to the fact that that individual will now be liable to income tax in that overseas territory if they're spending more than certain periods of time in that country over, let's say, a fiscal year or a 12-month period. And that has ramifications on the individual's net income or take-home pay. So a major part of dealing with expats is actually to design an expatriate package, both in terms of relocation, compensation elements, and the tax assistance that go in to support the expat package. Go on to the next slide. You'll see some typical examples of arrangements that we see. So a short-term expat might be anything up to 12 months. Commuters, so you might have an expat that goes from Canada to the USA or France to Germany. They daily commute across the border from their home to the office, or they might split their time. You do get commuters who spend 2 weeks in the US and 2 weeks in the UK, for example, and that has some interesting ramifications. Longer-term assignments may be anything from 2 to 5 years, or you might have what I call a one-way ticket or a permanent transfer, which means that people go out, they decide that they're going to relocate permanently from one country to another, and they effectively become employees, like a local hire, in the overseas territory, but you might give them some sort of relocation assistance to get them over there. So we go on to the next slide. I run through, without getting into the detail, because expat is a topic in its own right. We could be here for another 3 hours if we're not careful. But the 8 common mistakes that I see are failing to understand the immigration ramifications and the fact that you think you can get someone in either as a tourist, as a business visitor. It's a temporary arrangement which suddenly becomes longer term, and suddenly the individual's having a problem getting in through immigration. So keeping a good control over the data and the information of people crossing over the borders, and as the employer, it's your responsibility to get that right. There's generally a lack of understanding of the nuances and complexity of handling expats, and the lack of planning up front. So the unrealistic timing. So you expect to have an expat going over on the 1st of January without any thought about the visa, the immigration, the tax planning, the personal upheaval, and actually the lack of budget, because truly it's not costed. I have oftentimes spoken to clients who think throwing $20,000 at someone as a relocation package is basically the extra cost, and it's absolutely not. There are so many hidden costs that you need to be thinking through. The fact that the payroll, the tax implications flow through into payroll. Where is the individual going to be payrolled? How is he going to get currency in the local country? Can he remain on the home country scheme for Social Security and other local benefits or home country benefit programs? When we provide fee quotes for running expat payrolls, people are oftentimes shocked that the cost is slightly more, in fact it's a lot more, than running a local hire payroll through an ADP or equivalent. Well, the honest answer is, it's not simple running an expat payroll. It's not simply a gross to net calculation. Oftentimes it's a net to gross calculation, and oftentimes you're running a shadow payroll alongside a real payroll, so effectively you're running 2 payrolls. Again, I can't go into all the details right now, but it's a common misunderstanding that expat payrolls are as simple as local hires. On the next slide, we look at the fact that many companies quite simply lack the administrative ability to track where their employees are. And I call this the 183-day drift. So under expat tax law, typically 183 days in a particular country over a 12-month period is the trigger for generating taxability in a particular territory. It's a very broad rule of thumb, but it's a rule of thumb. But oftentimes companies do not have the infrastructure or the administration to track where their employees are working. So you get this, the expat, the commuter, drifting backwards and forwards, and suddenly they've been in territory for 200 days, cumulatively over a period of time. And technically there's an issue. And certainly the Canadian Tax Authority with the US border have cracked down on this, and it's a real problem. So having good administration, understanding what the rules are so that you can even think about it is fundamental. We then come on to some of the accounting treatments of where should the costs be booked. Should they be recharged? Does that create a corporate tax exposure? Does it create a permanent establishment of the home country if you haven't set up the assignment letters properly? And then coming on to the whole policy piece. The second to last bullet point there talks about the expat imposing their own demands and doing their own thing, because there is no standard policy. And what often happens, particularly if you've only got 1 or 2 expats, is that you cut deals. Even if you have a policy, you might vary it because it's the owner's son, or the individual has 5 children that needs to be accommodated. The problem is that expats will talk, and share information. If you don't have a standard policy, at least to start from, you'll often come into problems because you'll get the analogy, it's not fair because I haven't received X, Y, and Z. And then the final point is, we're not dealing with just a spreadsheet here. We're dealing with people, we're dealing with their families, and when you move from one country to another, there is considerable personal disruption, emotional upheaval, the loss of family and security, and going into a new territory can be scary. And the biggest form of assignment failure is actually because the family are unhappy. So I would encourage folks, if they're thinking about expatriates, to think about all these different elements before kind of committing to really signing off on that arrangement, and obviously take professional advice. As we begin to wrap up now, I'm just going to look very quickly at the last element here, which is around global payroll. Payroll is probably one of the underrated professional service lines that we certainly deal with, and it's actually really hard to get right in every country. It's not simply a gross to net calculation. It's making sure that you've got all the relevant compensation data. We looked at France as a case study where you have to report vacation or sickness days on the pay slip. There are points of detail. Different benefits get taxed in a different way. So how do you record that? How do you capture that data? And how do you pass it through to your payroll team to actually get it right? So if you've got a firm, a big international payroll firm, at the end of the day, they're only going to process what they're told. So if you don't know what it is you're meant to be telling them, there is a chance that they could get it wrong, inadvertently, I should say. And obviously, as you run a payroll, there are the usual things like income taxes, social security, etc. But these can vary by state, by canton, by province, and even city taxes. So being cognizant of that is important. This sort of penultimate slide, again, a reminder that obviously the US rules that for payroll in the US don't apply internationally. As I talked about, different types of remuneration will be taxed differently. Reporting obligations and timelines are different. Major one is around share schemes and equity reward in terms of when do you report a grant or an exercise or a vesting. Does that need to go onto the payroll, or is that something that's reported outside of the payroll? And the problem is with payroll is that it's a very visible arrangement, and the tax authorities in many countries will undertake frequent payroll audits, if not once a year, maybe every 2 to 3 years, and they will go through the files with a fine-tooth comb. They'll be on the look for things like contractor arrangements, severance payments, termination payments, etc. So that's where you begin to build up risk exposure, because you're opening the door, and it's a trigger point for audits in these countries. And finally, we are seeing greater visibility of these payroll type audits coming in. In the UK, we have real-time information reporting. China, there's a monthly individual income tax return that needs to be filed. And obviously, even in the US, each domestic state has different payroll rules. And if you have a mobile population of employees, even within the US, that can be a challenge for people to stay on top of. So I think, the key here is, again, don't underestimate the difficulty of running an international payroll. Seek advice and be just open-minded with respect to the fact that the different rules will apply. So that pretty much wraps up what I needed to talk to you about today. John, back over to you.
Great, thank you very much. All right, we've got time for just a couple of questions here, so let's go ahead and start attacking these, Katie. As a U.S. company, are there any restrictions to providing stock or stock options to employees in Europe?
Generally not restrictions. It's a pretty well-trodden path, but obviously there are nuances with respect to the stock plan documentation. I referenced data protection earlier on. Data protection clauses would need to be written. Depending on the country, there may be a requirement to translate the documentation into local language, which can be expensive. And obviously the tax rules and the reporting rules for exercises, for grants, for vestings will vary by country. As a general rule of thumb, you know, for stock options, for example, you're going to be looking at a taxable event on exercise, reportable through the payroll, and the taxes will need to be paid within a certain number of days after the taxable event. That will also then need to be shown on an end-of-year form in some capacity. You know, and the specific rules will be different by country.
Gotcha. Great. Next question. We're planning to have an expat go to a country that does not have personal income taxes. Do you still recommend tax equalization in that case?
Well,
in other words, and tax equalization, sorry, just to jump in. Actually, why don't I let you explain it? I'm sure you're much better at explaining tax equalization.
Well, the honest answer is if you've got one expat going to one country and that country is, let's say, Dubai, you might review the fact or the need or the recommendation to have tax equalization. Now, if you've got a widespread expat population going to low and high tax jurisdictions, the whole point of tax equalization is you are making people what we call tax blind, so that they are not cherry picking the locations to which they are going. So if you had someone going to Denmark, for example, which is a high tax regime, or the UAE, if you ignore the preference for the particular country, you might get someone jumping up and down and saying, I want to go to the UAE because it's a low tax, well, zero tax jurisdiction, as opposed to someone going to Denmark who's going to be hammered for higher taxes. Now, the point from a company perspective is if you equalize someone going to Denmark, you, the company, are going to be on the hook for some significant cost. And the way that you equalize that back out from a company perspective is by internalizing the tax savings for the individual who's going to the low tax jurisdiction. So even though the individual is now being hammered for what we call hypothetical or stay-at-home taxes, the company is better off because they're getting those stay-at-home taxes, but they're not actually having to pay anything else. But that's going towards funding other expenses to do with the expatriate program. So I think the answer, John, here is very much it depends on the program you have, the number of expats, and whether or not the UAE, for example, is a one-time deal or whether it's part of a wider program.
Mm-hmm. Great. Thank you very much. All right, that's the time we've got for questions. Let's keep moving on here. First off, thank you so much, Katie Davies of Radius, for the great information, very well laid out and presented. Thanks. Thanks again for coming. All right, we have a lot of conversations on this and related topics at Proformative. Please welcome, you're welcome to come and join your peers in the community to continue the discussion. Also, if you'd like an introduction to Katie directly or to Radius to have general conversations around this topic, just let us know in the post-event survey, which is coming your way right after our final polling question, which is going to be up in a minute. Of course, thanks to our good friends at Radius, whose commitment to thought leadership helped us make today's educational webinar possible and delivered at no cost to the participants. Radius, longtime supporter of what we do here for folks in the office of the CFO. And with that, we're going to go and move on to the third and final polling question. I am launching it right now. So does your company have an effective expansion strategy? Yes, no, or in between there. We'll leave that out for 30 seconds as we do with the other questions. I'm going to take this time to thank everyone for joining us today. Thanks so much. We appreciate how busy everyone is. Not easy to take time even for learning critical job skills. So thanks so much for coming and joining us and our friends at Radius today to have a great learning experience. We hope to see you again soon at another Proformative event or online at proformative.com. All right, with that, we're going to move to shut down the webinar. You will be sent to the post-event survey. We greatly appreciate your hanging out and giving us a little bit more feedback. And we certainly hope to see you again soon. Have a great week, everyone.